Afternoon. My name is Adrian Ramirez. I'm the Associate Director of the Career Development Center, and currently I'm overseeing the Money Management Center. And this is a Money Management Center webinar presented to you today on home buying. And this is, oh, Damien, are you recording? I think he's recording. Yes. Okay, perfect. And so this is, we have our community partner, Educational Employees Credit Union. Mike Jones is here to talk to us today about home buying, and he is going to go through the slides and let us know how to, what to think about when purchasing a home. So, like I said, if you have any questions, go ahead and ask in the chat, and I'll monitor it, and I'll ask Mike during the presentation, as well as we will record content. The content of this webinar and post it on our Career Development Center YouTube channel. So you'll be able to listen to it then. Okay, Mike, without further ado, thank you again for coming today to present.
My pleasure. So yes, my name is Mike Jones. No, I'm not the rapper. And today we're going to talk about preparing for home ownership. So what is the whole process? So the discussion items is first to do your research. The keys to home ownership, the home buying process, applying for a home loan, types of mortgage products, and then other important information and required documents. So first and foremost, you have to do your research. And a big part of that research is asking yourself what it is that you want. So what is the housing market like in the area that you want to buy? And what is it like in the neighborhood that you want to buy? What neighborhood do you want to buy? Some people, here in the Fresno area, maybe they want to be over North End. Maybe they want to be Central Fresno. Maybe they want to be in some of the new areas that are expanding out to the east. Or maybe you want to be in Clovis or one of the further out towns, such as Sanger or Dinuba even, or, you get to decide where you want to live, and you look at what the market is like in those areas, right? Because it's going to be different from area to area. You want to take a look at what you're wanting in the home. Are you wanting a one-story? And as people get older, for example, they're wanting more and more one-stories instead of the two-story because there might be some mobility issues. Or is it you want that two-story house? You always love the look of it. Is there a particular style of house that you like? For example, my favorite style of house is the craftsman style. Now, that's not the style that I owned, but that is my favorite style of home. So you get to really think through all of those questions. And you take a look at how much you can afford. That means you're going to need to sit down and do your budget. So you're going to need to take a look at how much money you have coming in, what's going out for your other expenses, and you need to take a look at all of your expenses and how much you can afford for the home payment. And then what do you expect from your real estate agent? And we'll talk some more about that in just a moment. So people always want to know, what is it that we're going to look at when we as a lender are evaluating your application for a home loan? Well, we're going to take a look at job stability because employment stability does matter. And we're specifically going to take a look at the last 2 years. And we're going to take a look at, how stable you are over a longer period of time, but we're going to look in detail at the last 2 years. Some people have full-time work. That's fine. Some people have part-time work. That's fine. Some people have changed jobs in the last 2 years. That's fine too. There might be some incidences of gaps of employment, and you're able to explain with a reasonable explanation of why those happened. For example, right now, there are a lot of people that are unemployed because of the state of the economy right now. And as the economy opens back up again, people are going to find jobs again. They're going to be able to get into a position where they can start applying for home loans. And they're going to need to explain why they were out of work. Well, it's a very reasonable explanation that the state of the economy is such that some businesses did close down. So we take explanations into consideration. Now, looking at the job stability, we're going to look at the income, right? And what type of income and how do you prove your income? Well, we're going to take a look at all of those pieces of paper that prove your income, such as your pay stubs and your W-2s If you're self-employed, we're going to take a look at the tax returns. So some people have what we call regular pay. They're either salaried or hourly. Some people have retirement pay or pension or Social Security. Some people have disability income. Now, some people think that these other types of income are not going to qualify them, but that's not necessarily true. We take a look at all sources of legal income and the amounts. It does not matter what the source is as long as it's a source of legal income. Some people have two buyers that are going in to buy the home, like you and a spouse. Well, that's fine. Co-borrowers are fine. We'll take a look at both jobs, both incomes. Now, some people have overtime, bonuses, and commission. We're going to take a look over the last 2 years to see how stable, regular, consistent those are. If they're just once in a blue moon that you get an overtime, a bonus, or a commission, okay, that's in one category of analyzing it versus if you're getting it every month or every quarter. Some people have a second job or a second part-time job. We take all of that into consideration for everything for the last 2 years. And again, some people are self-employed. We're going to take a look at tax returns. Now, when it comes to how much income do you need, we're going to take a look at all of your debts in comparison with your income. And when we take a look at your income, we're taking a look at your income before anything's taken out. Because you know there's what you make, and there's all the things that are taken out, and then there's your net pay, right? And your net pay is hopefully a good amount, but we're going to take a look at the gross pay, the before anything's taken out. And you need to not have debts that are taking up 50% or more of your gross pay. Okay, so that would be your car loan, your home loan or the projected home loan that you're going to be getting, your student loan, your credit cards, all of those monthly debt payments needs to be underneath that. Now, we would suggest that you go clear under the 50%, shoot for 43% or lower, the lower the better, in order to qualify for an excellent interest rate on your home loan.
Okay, Mike.
Yeah.
We have a few questions already, so this is good,
Yeah.
but you're covering the content. So I want to make sure that you address it in the future. Yeah, take a drink for sure. You're talking a lot. So couple questions are, so when you talk about gaps in unemployment, what is an acceptable gap as far as unemployment goes?
You mean acceptable length or acceptable explanation?
Acceptable length and explanation, I guess.
Right. Well, if your gap has been 2 years, we need to get some employment, right? So, if you've had a couple months, if you've had 6 months, some people might have been out of work for the last year. Okay, well, you're going to need to get back into the workforce and, maybe get another year's worth of stability in place before we can get that qualified. Because we need to know that the employment is stable. But, if it's been 3 months, if it's been 6 months, but you're able to show that you're back into the workforce, we take that all into consideration. Now, if you've been unemployed for 3 months, 4 times in the last 2 years, then we need to take a look at why the income is not stable.
Okay. And then another thing, these can kind of be combined. You're talking about it right now, like student loans impacting the process. That's part of the debt to income ratio, like you were talking about. And then credit scores, which you have on the slide right now. So I'm pretty sure you're going to be talking about that too.
Right.
So
Let's talk about credit scores. Let's talk about credit reports and credit scores. As you probably know, because I'm sure all of you have come to my previous workshops, that there are 3 credit reporting agencies in the United States: Equifax, Experian, and TransUnion. Now, we recommend that you do get a credit report from them, each one of them, every year, and make sure that it's correct. And we recommend that you go to the website that's on the screen there, annualcreditreport.com, because you want to make sure that the information on there is correct. Now, FICO is a credit score formula. There's many different formulas. FICO is the most common. FICO's traditional, they have many different score formulas, but their traditional formula gives a score somewhere between 300 and 850. Okay, so you use that formula on your Equifax. You use that formula on Experian. We use that formula on TransUnion. Now, your Equifax might or might not be exactly the same as Experian. And Experian might be slightly different than TransUnion. So this formula that we use on all three of those, even though it's the same formula, it's evaluating slightly different information. So we might get slightly different scores. So what score do we use? If there's you, we're going to have 3 scores. If there's you and a spouse, that spouse is going to have 3 scores. We're looking at 6 scores there. What are we going to use? Well, let's take a look at some of the scores that you need to get, and then we'll take a look at an example of 2 people. Okay, so EECU considers the lowest middle score. And I'll show you what that means. But if you're getting an FHA loan, which is a type of loan that is guaranteed by the Federal Home Administration, meaning if you default, the bank can go back to the Federal Home Administration to guarantee that loan. They require a credit score of 620 and above. Now, your conventional loan is a type of loan that is not guaranteed by the Federal Home Administration. It's not a VA loan. It's not guaranteed by the Veteran Administration. It is just your regular bank or credit union loan. And typically 620 might get you a loan for your home. But it's going to require a higher interest rate, right? So the 620 means that the interest rate that you get most of the time is a little bit higher. Now, when you get your credit score to the 700 level, to the 740 level, you go above the 740, get closer to the 800 level, you're going to see that the interest rate that you have to pay goes down because your credit score has gone up. Okay. Now, when somebody, meaning a lender, is looking at your credit score and your application, we use a formula of FICO that includes what's called a mortgage factor. There are things within the credit report that indicate more accurately somebody's ability to successfully handle a mortgage. And so those are weighted more heavily than other factors in a traditional FICO score. So your FICO score that you get from some website that you go out and get, that's fine. But then when you look at your FICO score that includes our mortgage factor, saying, whoa, they're different. It's like it's because we're weighting different things as more or less important. Okay, so here's the example. So let's say that this gentleman here, he has 3 credit reports, and we use the formula on all 3 of those, and his scores are 790, 799, and 760. Now, each lender can decide what score they use. For EECU, as an example, we use the middle score. So 790 is between 760 and 799. Okay, but then there's his co-borrower, and she has a score of 804, 788, and 765. So her middle score, 788, is between 765 and 804. Okay, so there's 790 and 788. Between those, what do we use? Well, we're going to use the lower of the 2 middle scores. So there's not a lot of difference in this example, but that's the score we would use. So hopefully that kind of clears up the mystery of what scores are used. But again, every lender can decide. I've worked for some lenders where they just look at all the scores and they pick the lowest one. The lowest one is the one that they're going to use. For us, we use the lowest of the middle. Everybody always wants to know, what cash do I need? I have to put something up front. I have to pay for things up front, and I have to pay for things at the end. What is up front and what is at the end? Okay, well, first off, your down payment. Obviously, your down payment is going to be up front, kind of. Part of your down payment is required at the beginning of the offer, when you want to offer your bid for the home. And the rest of it is going to be due at the end of the process when we close escrow. So how much of a down payment? So 3.5% of the home loan is required for FHA. For most conventional loans, 3%. Now, there are many lenders that are going to try to get you to the 20%, and EECU is in that category. we require 20%. And we're going to explain to you why in just a minute. But 20% does put you in a position where there are some costs that you don't have to pay for. That if you put less than 20%, you have these additional costs every month that you do have to pay for. And I'm going to show you those in just a moment. Now, where do these this down payment come from? Well, some could be gifted funds. So maybe your parents, grandparents, or other relatives have gifted you money to buy a home, and you're going to use that for your down payment. That's fine. Some people are going to use their investments, like their 401k. That's fine too. But make sure and talk to your tax advisor, because that has tax consequences, and we're not your tax advisor. When all of the dust is settled and you get into that home, we want to have calculated and projected that you will have 2 months worth of required expenses. And that is what we call PITI, principal, interest, tax, and insurance. So you know that with any loan, there's the principal amount that you borrow, and there's the interest that you pay over and above that. Well, with a home loan, you're also going to have to pay taxes, right? Every year you have to pay taxes, and you have to have insurance on your home. So if you break all of that down monthly, we call it PITI, principal, interest, tax, and insurance. And we want to make sure that when all the dust is settled and you get in that home, you now have 2 months of reserves to cover those. In addition, right up front, some of the things that are going to be out of your pocket is going to be an appraisal and a flood certificate. So the appraisal for the Fresno area, you're looking right around $400, $450. If there is kind of a larger home, or you have more property, acreage with the home, it might get up to be like the $500 range for the appraisal. The flood certificate is required. Every county in the United States requires that we certify whether or not the house is in a flood zone. And the cost for certifying that is, I believe, $16. So that's really minimal fee. Now, some people also choose to get a home inspection, and this is optional. I've always gotten one on the homes I've purchased, and we just hire an expert at the home, and they go through top to bottom, front to back, left to right. They look at everything, and they give you an evaluation of what is good or needs to be improved on the home. And they're not telling you to buy it or not buy it. They're just evaluating the home with their inspection.
Mike, before you move on, can you go over PITI again?
Sure.
That was they were just asking about that, and how do you calculate it? And
Yep.
So thank you.
So the principal and interest, that's an easy calculation, right? That's your loan, right? So just like with and some of you have a car loan right now. And when you make your payment and you look at the statement, part of that brought down the balance and part of that went to interest, right? But in addition to that, on your home loan, you have tax and insurance. So your tax is a certain amount per year. For example, on my home, my taxes, property taxes, are right around $2,000 per year. So that $2,000 divided by 12 is what we would figure on your monthly taxes. And then my insurance is, it's a certain amount that is per year. We divide that by 12 so that we get the amount that we can then put all together as your estimated principal, interest, tax, and insurance. Cool. Okay. When you go through the process of you have put the offer in, which we'll talk about it in more detail in a moment, and the offer is accepted, and you've put part of your down payment in. The rest of the down payment at the very end of the whole process, we call at closing, which is when escrow closes, the rest of your down payment has to be in. Now, that very first amount, that first part that you put into your down payment, that's actually called a good faith payment. So when you make an offer, you fill out a check and you submit that check with the offer. It might be a few $1,000s or a little bit more that you are putting in as your good faith down payment. That is showing the seller that you're serious, okay? So at the very end of the whole escrow period, you have to put the rest of your down payment in. What is escrow? Okay, there's an escrow company. This escrow company's job is to make sure that everything in this process is going correctly. So, the person selling the property, they have paperwork that they have to do. They have things that they have to provide. Your lender has to provide the contract, and there's paperwork that they have to provide. Your insurance company needs to provide the insurance quote. The flood certificate has to be in. Somebody has to keep track of all of these things and make sure that everything is where it's supposed to be and that it's going to where it's supposed to go. That's the escrow company. So that's what is meant by opening escrow is the escrow company has been hired to start tracking all of this. And close of escrow means they have done all of their job, including making sure that the title company has done their job. Now, here in the Fresno, pretty much the greater Central California area, your escrow company and your title company are probably going to be the same company, even though they're doing two different processes. And the title insurance part of that is they're looking at the title of the property. So on record, who owns the property? Is that who's trying to sell it? So if on my property, there's me and my ex-wife, and I'm trying to sell it, they're making sure that, oh, this ex-wife is on the title too. She has to be included in all of this. Maybe there's been a lien against the property. Maybe there is a hospital bill that I haven't paid, and the hospital finally put that lien on the property, meaning I can't sell my property until I pay off that debt. They just kind of stopped me from doing anything. So the title insurance company makes sure that the title is clear, that the person trying to sell it has the right to sell it, and there is nothing that is going to stop us from selling that to the person that wants to buy it. Impounds. Okay. There are some mortgage companies, some banks, credit unions, mortgage companies, that when you make your payment every month, part of it goes towards principal, part of it goes towards interest, and they take part of it for your taxes and part of it for your insurance, and they put the tax and insurance in a savings account. It's called an impound account. They put it in the savings account so that when your tax bill comes or when your insurance bill comes, they then take the money out of that savings account and pay that for you. Now, there are other lenders, such as EECU. We don't do that for you. What we do is we help you set up a savings account, and we tell you, okay, this is the amount that you should be putting in there every month, and we can even help you set up a direct deposit, but we do leave that within your control. But for those companies that use an impound, you've got to prepay some of those taxes and some of those insurances in order to have it fully funded as you're going in. Then there's lender fees. And oh my gosh, there is a wide range of lender fees out there. EECU for a base lender is like $500. Then you're going to have over and above that the title insurance that we talked about, the inspection if you want it, and all of that. But I've talked to some other lenders just this last week whose lender fees were like $4,000. It's like, so you need to take a look at that. Now, some of those lender fees are expressed in what is called points. They're like, oh, this is the rate you get at no points. This is the rate you get at 1 point or half a point. Okay, 1 point equals 1% of your loan. Okay, 1 point equals 1% of your loan. So if they're charging you 1 point, you're paying a 1% fee. And what does that go towards? It doesn't go towards anything. It's a fee. Okay. And then homeowners insurance premium. You need to make sure that your homeowners insurance is funded. There's another insurance product we're going to talk about. And that's where we get back to that 20%. And that is private mortgage insurance. Okay, think about two different borrowers. One borrower is borrowing 80% of the loan, of the home value, because they're putting 20% down. Another borrower is borrowing 97% because they're putting 3% down. Okay, so which one is a mortgage company going to consider as the lowest risk, and which one is going to be considered as the highest risk? Well, the one with the larger down payment is going to be the lower risk. The one with the higher down, with the one with the higher down payment is the lower risk. The one with the lower down payment is the higher risk. So here's the fact. We are required that if somebody puts less than 20% down, to have this extra insurance. It insures us against you not being able to stay in that home. If the home has to be foreclosed on, this private mortgage insurance will kick in and help the financial institution not take as big of a loss. You pay that insurance premium though. So if you're able to put down 20%, you don't have to pay the private mortgage insurance. If you can't put down 20%, which on both of the houses that I have purchased, I did not have 20% to put down, you have to pay this extra private mortgage insurance. Now, if it's with FHA or with a conventional loan, when you get to the point over time that you have brought the balance of your loan down, because every month you make your payment and the balance finally comes down to where it would have been equivalent to having put down 20%, you can get that PMI, private mortgage insurance, canceled, right? So you don't have it for the entire life of your loan. You only have it until you've paid enough into it to where the balance comes down to where you now only owe 80% of the value, okay? Now, I'm anticipating there might be a question or two before I move on.
Oh, there's plenty of questions, Mike. Can a non-citizen with a good credit score seek out an FHA loan?
You broke up. Say again, please.
Oh, I'm sorry. Can a non-citizen with a good credit score, can they get an FHA loan?
It's a great question. I will have to find out. To the best of my knowledge, yes, they can. But I would have to, I have an expert that I would definitely need to ask that question to. I will give you my my email address at the very end in the chat, so that if you have those types of questions that I don't know the answer to right off the top of my head, you can email them to me and I will get back to you with an answer.
Also, like Social Security, is that needed, or can an ITIN work? ITIN work?
Yeah, an ITIN. And an ITIN is an individual tax identification number, and that is for people that have come to the United States and do not yet have a Social Security number. And yes, to the best of my knowledge, an ITIN does work. Email me though, because I will double check for you.
Okay, and then does getting a home loan?
I'm a generalist and I'm an educator, so I'm going to convey all this information, and I'm certainly okay with saying what I do and don't know, and then I am happy to research for you.
Perfect. Thank you, Mike. I appreciate that, though, letting students know and the audience know. So does getting a home loan through EECU, does it require 20% down even if it's an FHA loan?
Right, because those are the only ones we do. However, if you don't have 20% down, we have resources that we can refer you to.
Okay, and then let's see. Oh boy, there's a lot of them. There are a lot about everything. So first-time home buyers, what types of programs are there available other than FHA? Is there any others, or?
Right now, because the interest rates are so excellent right now, a lot of people don't go FHA because the conventional loan interest rates are just as good as FHA, if maybe even better. So if FHA is one of the options. But there are down payment assistance programs that can help you out. So if you just look up DAP, Down Payment Assistance Program, some of them are for specific areas of town. Some of them are for particular professions. Like there are down payment assistance programs for people that work in law enforcement. There are down payment assistance programs for people that work in education. You know, and I think that one's called the teacher next door, and there's one called the officer next door, or there's all sorts of those. So you want to take a look at those. The Fresno Housing Authority would know more about those as well. And you know, you might.
Fannie Mae and Freddie Mac, are they FHA or?
They are what's called a secondary market. So Fannie Mae and Freddie Mac, they don't make a loan to you. They purchase the loan from a bank or mortgage company or credit union. So there's what is called conforming. So this is the more advanced information here. Okay, so there are certain conditions that have to be met for a bank or credit union or mortgage company to have made a mortgage loan to you and then sell it to Fannie Mae or Freddie Mac. Now, why would they do that? Why would they sell it? Well, because they then get money and they can make another loan. So it's a way of getting them to have more cash in the community to do more loans. Some people don't like that. Some people do not like their mortgage being sold. EECU, for the mortgages that we do, not the ones that we refer you to somebody else, but the ones that we do, we actually keep all of our mortgages, which is very odd. People are like, I can't believe you do that. You're like the only one. There's a few of us. But if Fannie Mae and Freddie Mac, they set the conditions under which a mortgage must fit for them to be able to buy it. And so that's called a conforming. So if you ever see something out there that says a, 30-year fixed conforming mortgage, you're like, what is that? Okay, well, it's a 30-year, and we're going to talk about fixed in a minute, but your fixed interest rate conforming means that it is done in a way that either Fannie Mae or Freddie Mac will purchase it. I don't know if that answered your question.
I don't know either, but you know what? Let's just go on with it.
Okay.
Is there any other different types of loans for people who want to buy investment properties?
Investment properties definitely are a different animal. Investment properties typically take a larger down payment. It's not unusual for an investment property to require more than 20% down. It might require a 40% down because it is not owner occupied. Anytime it's not owner occupied, it's an investment property or a second, like a vacation home. We do vacation homes. But if it's an investment property, it does require a larger down payment.
Okay, great. Yeah, let's go ahead and continue on with the presentation, and then maybe some of the other ones will be addressed later.
You need to find a real estate agent that you are comfortable with, right? So obviously here's the most famous real estate agent that we all know from TV. But you're going to ask your friends, your family for a referral, and make sure it's somebody that they were happy with, not just somebody that they've heard about, but that they are happy with. You want to know about your agent's reputation and the company that they work for. Is it a good reputation? How long has that agent been in the industry? Now, I'm not saying that you shouldn't use somebody who is new to the industry. Maybe they're going to do an excellent job for you. Interview them and ask and find out. About 3 years ago, the people across the street from me sold their house, and they used an agent that this was his first house. He had never sold a house before. He was brand new to the industry, but it was their brand new son-in-law. So they kind of felt that they had to use him, and he did an excellent job for them. Of course he did. This is his first one, and it's for his in-laws. You know he was going to work hard. But that is an example of a brand new agent doing an excellent job. There are some agents, I have a relative who's been in the industry, gosh, for 30 years, I think. And so they know a lot about the industry and about the area. So you get to interview the agent to decide whether you like them or not. Is this their full-time job? There are some agents that are doing it part-time. And if you're happy with that, that's showing that they have their base income at their full-time job, and then they're doing this part-time, that's great. Or do you want somebody who does not have anything else on their plate, just you and real estate? Are they organized? Big deal, right? Because there's a lot of pieces that move, and you want to make sure that they are organized. How do you get your offer approved? Okay, well, one thing you need to do is get pre-approved for your loan. So when you want to look for a house, the very first thing you need to do is find your agent and get pre-approved for your loan. You're going to contact hopefully the credit union, but whoever you like, and get pre-approved for a loan. You're going to do that before you start shopping, because when you find that house that you want to put a bid in on, it shows that you're serious, and it shows that you are ready to rock and roll. When you make that offer, you've already been pre-approved. They know that you don't have to all of a sudden go and find a lender. The process can go very quickly.
Real quick, Mike, on that one. What happens if you put down a good faith payment and then your offer is not accepted? What happens? Or what are your thoughts?
Yeah, the check isn't even cashed until escrow closes. So they just hand you your check back.
Okay, thank you.
Yeah, that one's simple. There are many types of mortgage products out there. So I've told you about the conventional, regular bank or credit union loan. There is government-backed loans such as the FHA and VA. There's a jumbo loan, which to me is kind of a weird concept. So I believe it's right around the $543,000 range. I think that's it. That if the loan is above that, it's considered, in California, it's considered a jumbo loan. And there are certain conditions that the mortgage company has to fulfill in order to do that loan. Now, is that anything that you have to worry about? Nope, nothing that you have to worry about. The mortgage company is going to know what the requirement is, and they're going to know how to do that. Now, here in California, something above $543,000, now that's definitely much higher than the value of my home, but there are definitely a lot of homes, especially in California, that are worth that and more. So how they came up with that is a mystery. Variable interest rates. Okay, you can get a loan with an interest rate that is not fixed. It's variable, which means it can go up and down. Now, right now, the loans are pretty low, so I don't think a variable interest rate is going to go any lower. It's just my guess. But there are times when interest rates are pretty, they're higher, and a variable interest rate, the interest rate could go down. But what about it going up? There is a certain amount that it can go up either monthly or quarterly, annually, and then over the life of the loan. And that's all spelled out within the deal, within the contract that you sign. Variable interest rates typically start off a little bit lower than fixed interest rates. They're like, ooh, that variable interest rate looks very appetizing. And it is appetizing because the mortgage company knows that if the economy heats up, then they can raise the interest rate. Again, they can't just go zoom and raise it huge. There's only a certain amount by which they can raise it either monthly, quarterly, annually, or over the life of the loan. And that's all spelled out. A fixed interest rate is exactly what it says. If you find an interest rate right now, you might be able to find an interest rate of 2.75. That's like, pretty good rate. 2.75 fixed. Okay, fantastic. A year from now, it's still going to be 2.75. 10 years from now, it's still going to be 2.75. For the entire length of the loan, it's going to be that interest rate. Now, after you get in your home and you've been in there a while, there are a lot of people that want a second mortgage. They get a home equity loan, and they might do that to do some repairs at the house, or maybe an addition, or they can even use it to go on vacation. You can use it for any legal purpose. You can take money out of your home in a home equity loan, And again, the home equity loan might be fixed or variable. Most of the time, I see home equity loans as being a variable interest rate. I got one, oh gosh, 20 years ago. It was a variable interest rate. And that made me nervous. And then the interest rate went down. Didn't make me nervous anymore. But interest rates are pretty low right now. Okay, making your offer. You are going to rely on your real estate agent to help you know what is a good offer, right? Your real estate agent knows the real estate industry. They know the area. They know the neighborhood. They know what has been sold recently. They can help guide you in the process of making an offer. You're going to take a look, you and your real estate agent are going to take a look at what similar homes have sold for in the area recently. And they're going to take a look at how long that home has been on the market. For how long has the for sale sign been up on that house? Just around the corner from me, it's very interesting. There are two houses side by side, literally next door to each other. And both of them put a for sale sign up within, probably a week of each other. One of them sold in less than a week. And the other one has had the for sale sign up there now for probably 2 months. So I don't know what they're asking, but the longer it's up there, the more they might be willing to say, okay, we need to bring the price down in order for somebody to buy this. So they might be willing to make a deal, right? What is the condition of the home? When I bought my home, when it rained outside, there is one room where it also rained inside. So I very quickly got the roof patched, right? But I took that into consideration when I made my offer. So what is the condition of the home? Why are they selling? Are there other offers? If there's a lot of other offers, then that might have to mean your offer is a little bit, needs to go up a little bit more, right? And you need to be prepared to negotiate. There's all sorts of things that might be important to the sellers. Getting your offer accepted. Now, we watch these programs on TV. You watch them, I watch them, we just love them. And we see, they make an offer and then the seller counteroffers and then the buyer counteroffers, and somewhere in the process, you come to this agreement. That might happen that way. The other thing that might happen is you get one shot at it. And there's no way of knowing ahead of time how that's going to play out. So you need to remember that first shot might be your only shot. So consider that, right? Make sure that you are pre-approved before your offer is presented. If you have a home that you are selling in order to move to your new home, it needs to be an escrow at the time that you make the offer. And be willing to negotiate items such as, okay, is the closing date closer or farther? Rent back, maybe the closing date is really close, but the people that are selling the house, they can't really get to their next place at that time. So they are arranging, negotiating with you where they're renting the home back from you for a time period. And if that works for you, then hey, it's a way of getting some cash to make your first couple payments, right? So whatever is important to you. The other thing that might help you get your offer accepted is to increase your earnest money. So again, that is the amount of your down payment that you're putting as a check right up front. And that just shows that you are more serious. When the offer is accepted, the earnest money is deposited to the escrow company. Your lender is contacted, the contract is provided, your loan at your lender is finally processed, all the final approvals. If you're getting a home inspection, that's done, the appraisal is done. And then at the very end, there's what is called the final walkthrough. You and your agent meet at the house and you walk through the house to make sure everything is as it's supposed to be. So when I walked through the house with my agent, the back window was broken. And it's like busted. So it's like, okay, need to get this fixed. So before escrow could close, they had to fix that window. That's what the final escrow is, making sure that everything is as it's supposed to be, the final walkthrough. Then you sign, I mean, the stack of documents is huge. You sign and you initial and you sign and you initial. The lender wires the funds to the escrow company. The escrow company verifies the title, the insurance, the home warranty is in place, and they make sure that the new ownership is recorded with the county. The fact that you own a home is public record at the county. The agent hands you the keys and you move in. Nice. Okay. Questions?
All right, Mike, a lot of stuff, a lot of good stuff to talk about. So, do you have to use a real estate agent?
No, you don't. But if you don't, that means that you need to be well versed in all of those things that the real estate agent goes to school and gets a license for. You need to know how to do all of that. I don't know any of it. I don't know how to do any of it. So I have used an agent both times that I have purchased a home.
Yeah, that's good. So do you think it's really worth it to put money down or wait till you get to that 20%, or should you go in at a lower and get that PMI? Is there a best case scenario?
There is no best case scenario. Every person, every situation is individualized. For me, I just didn't want to wait. You know, for my first home, I had a great aunt that gifted me 3% so that because I didn't even have that. I didn't have the money. So, and if I told you how long ago and what the expense of that home was, you would laugh. It's like, that's all. That's like pay more than a car. So she gave me 3% down as my down payment. You know, so yeah, I had the PMI, and I had that for a few years until I could show that I had the 20% value in the home. But I've talked to other people of like, absolutely not. I will not get a home loan until I have 20% down. You know, while I was in that home, I actually rented out part of my house to a roommate. And he lived there for 6 years while he was saving for a down payment. And he saved until he had 20% for a nice house in Clovis. So every situation is different. You have to decide what you're comfortable with.
I agree.
I
agree, Mike.
I don't want to wait.
On average, about what percentage is a real estate agent paid?
Right.
Is it a percent of the home, or is it a percent of the? Yeah,
it's a percent of of what the selling price is. You know, and the real estate agent can charge less, but I've seen like the 3% and 6%, 3% and 6% out there. So, you know,
yeah, that's fine. So it's a seller's market. You know, a lot of people are making comments right now. There's low inventory. So if the unemployment is so high right now, why is the housing market so high right now? What, you know, people
don't want
buying.
to. The inventory, meaning what is for sale, is either up or down based on people wanting to sell their home. So a lot of people are kind of nervous right now. They don't want to give up what they have. So it's like, oh, I might want to go to that next house, but not until the economy gets better. So I think I'll hold off. But there are other people like, oh, but you know, it's a seller's market. You know, I can make a good profit on my house. So I'll put the sign up now. So those are the things that are kind of happening at this point. You know, two different people are going to have two different attitudes about what they are comfortable or not comfortable with within the market. But yeah, there are a lot of people that are saying, yeah, I'm not going to make any kind of move until the economy is better. And the next door neighbor will go, hey, wait if you want, but I'm striking while the iron's hot. So
yeah. Yeah. So does someone need to go to a bank to get pre-approved and then go to an agent to get this process started?
You can do both at the same time. And, you know, it doesn't matter if today you do one and tomorrow you do the other, or vice versa. That's just the first two things that you're going to do. Is you're going to find an agent and you're going to get pre-approved for the loan.
And is the real estate agent, are they paid by the seller or the buyer or both?
Right. Yeah. So the seller pays the vast majority of it. Um,
Okay.
but yeah.
Definitely. So what's the difference between getting a loan at EECU and maybe another bank such as Bank of America, Wells Fargo, those other banks? Is there
Yeah.
any? Yeah.
Yeah. From what I've seen, you're going to shop for rate, right? So somebody has a better, a lower rate than somebody else, but you also need to shop lender fees. EECU lender fees are very low in comparison. The other very odd thing, and I'll say this, the odd thing about us, it's the only place that I have worked that we, for our home loans, it's not based on your credit. I mean, once you meet our credit requirement, then you get our best rate. So a better credit score doesn't get you a better rate. Everybody on our home loan gets our best rate. For other lenders where, yeah, the score really is deciding what your interest rate is going to be. So EECU is like, hey, our best rate is our best rate. So, if you've got a score of 700 or 690, and you're like, oh, that means I can't get the best rate over at these places, but I can get the best rate at EECU, um, you know,
Yeah, sure. There's no counter offering or first offer when you buy a new home, right? That you're buying from the builder,
or you
correct?
need a brand new build.
Yeah. There's no counter offering there.
Well, actually, I've seen it. If the builder is having a hard time getting those homes sold, make an offer. The worst they can do is say no, right? I mean, literally, that's the worst they can do. Is you offer less than what they're having it for sale for, and they say no. You go, okay, well, I'll pay the full price. But typically, a builder is like, this is what it's for sale for, and that's what you're going to buy it for. But if the economy is such that they have built these homes and nobody's buying them, you know,
Yeah.
they might make an offer, take an offer. Now, some of the builders, they don't even start the home until you've committed to it. And that's really common these days as well. They just have all these plots and they have the show homes for you to take a look at. And then you say, okay, yes, I want this home on this particular piece of land. And there's really not negotiating on that because they haven't built the home yet. They're not out money.
Yeah. Okay. What are the advantages and disadvantages of a 15-year loan, a 30-year loan?
So the obvious is in 15 years, you get paid off faster. Your home is paid for. The other thing is your 15-year interest rate is normally less than your 30-year interest rate. Because think about the risk. The longer a loan, the longer the risk. So the shorter the loan, the shorter the risk. Less risk means a lower interest rate.
Good. Okay. And then let's see. Is there different like teacher programs you were talking about or mentioned that different?
Down
Yeah.
payment assistance programs, right? I know there's one called the Teacher Next Door. But yeah, you can Google. We don't necessarily have those through EECU. You can get a down payment, assistance program, and that we're happy with that. But we're not the ones that are coordinating that for you. So you can just go, Google down payment assistance program. Fresno County. You can take a look at the Fresno Housing Authority website. They might have some on there. Yeah.
Okay. So how's the process different if you want to buy the land first and then later on build the home?
Yeah, there are lenders that specifically have those types of home loans. It's a builder loan where you are buying the property, you're putting the house on it, and they just have the process very smooth for you to do that. Now we don't do that. That's not what EECU. We don't EECU. We have what we have, and we're very good at what we do. And we're not going to pretend that we do everything for everybody. To try to do that means that we would do something not as good. So we don't do those types of loans. And we've seen people be very happy with getting the property, having the house built, the house is being customized exactly to what you want. That's great.
Yeah.
Yeah.
Can someone sell a home after 5 years of buying it and they still have a loan?
Yes, you can sell a home anytime. You can buy a home today and sell it next month. You just have to sell it for enough to pay off your mortgage.
Yeah, makes sense.
Think about it the same as you would think about a car. Can you sell a car that you still have a loan on? Yeah, you just have to sell it for enough to pay off the loan. Same thing.
Okay. Do they require first-time home buyers to take a class or any type of training or webinars like this?
There are some down payment assistance programs that do require you to take a class. And most of those classes are through the Housing and Urban Development, so HUD. And you can take a look at their website, or you can just Google first-time homeowner HUD certified classes. There is, I know there's where I used to work did those, but I've worked where I am now for 20 years. So they did those, it's just, they're wonderful. You learn an awful lot about the home buying process and the home ownership process.
Okay. So is it recommended to get like a 30-year loan and then maybe make additional payments and pay it off in 15 years so you avoid extra fees and interest and things like that? Or should you consider doing a refinance or?
All of that are acceptable choices.
Yeah.
When I purchased this home, I did get a 30-year fixed mortgage, and I have been putting extra money on it. I've been putting about $150 extra every month, so that it actually comes out to be about like an 18-year loan instead of a 30-year loan. Other people, they're like, I can do the 15, and if they can swing the 15, fantastic. So your interest rate is going to be lower if you go in at a 15-year loan versus a 30-year loan. If you're like, I'm not sure I can make that big of a payment every month, okay, then get the 30-year, make some extra payments as you can.
Yep, I agree. Okay, so well, we're getting close to the end of time. So I want to thank Mike for being with us today. He put his email in the chat. So for those of you listening, we had a lot of people listening. And